Hello everybody, this is Miraj Aslam from Jalil Institute, and today I'm here with a new past paper video. Yet another 2016 May-June session MCQ paper, but this time this is the second variant. You've got clear instructions on the first page. As usual, make sure to read them very carefully. And as you guys know, we have 45 minutes to finish all of these 30 questions. Simple tips: do not get stuck on any single question for too long. Move ahead, try to complete the other questions that you know well, and then get back to questions that you can understand at first. So let us begin the paper. We have got just 90 seconds for each question. We'll try to ensure that we complete our paper within 45 minutes. First question: what economic concept must be at work when there's a movement by a country along its Suppression possibility curve? So when there's a movement along a Suppression possibility curve, so for those of you who don't know what's a PPC, just focus here. Usually there are two products on x-axis and y-axis, and there's a PPC diagram which shows the maximum combination of either of these two goods, the different combinations of either of these two goods that you can possibly produce. So that's why we call it PPC, production possibility curve, right? So the question is, what economic concept must be at work when there's a movement by a country along its production possibility curve? So let's say if there's a country that produces product X and product Y, and if there's a movement along the PPC, which concept is at work? The economies of scale? Well, no, it has got nothing to do with economies of scale. The equilibrium price? No, because equilibrium price is a completely different concept that has to do with demand and supply. Maximum profit? No. Opportunity cost? Yes, because as we move from this point on to this point, we are having an opportunity cost. We're sacrificing certain amount of unit Y in order to gain certain amounts of unit X. So as we gain certain amounts of unit X, we sacrifice certain amounts of unit Y. So D is the correct answer, guys. Moving on to the next question. The diagram shows the choices for an individual between leisure and earning. Alright, the person decides to take a job that gives more leisure time. What is the opportunity cost individual of moving from point Y to point X? From point Y to point X. So we're moving from point Y to point X. So the movement is towards left. So we sacrificed $20 in earnings in order to have 4 extra hours of leisure per day. So the sacrifice that we're making here as we move from point Y to point X, or position Y to position X, is $20. We are minus $20 here as we move from 80 to 60, and we get 4 extra hours of leisure time per day. So the answer is so straightforward, it's 20. Alright, all the other options are gonna be wrong. So if you know the correct answer, you don't need to revisit all, but during explanation sometimes I go through all of these other options as well, so as to make the explanation better. But I think you pretty much understand this concept well. Okay, what is the best example of the existence of an economic problem? The best example of the existence of an economic problem, let's look at these examples now. A government provides accommodation for all those who are homeless. No, this is not the economic problem. That means government has unlimited resources, which is not true. There will always be you can say, a scarcity of resources. That's what creates the economic problem. That's the root cause of the economic problem. There's going to be scarcity of resources. A police force has a lengthening list of unsolved crimes. Let's look at other options as well. Janitha hands her homework in at the last permitted deadline. Nope. Musa completes his journey without putting petrol in his car. Is that even possible? That's so stupid. Yeah. So B is the only appropriate answer here. A police force has a lengthy list of unsolved crimes. Now this can be tricky. You have to understand that police force is a resource. When you're creating a police force, you're using so many of these inputs. There's a lot of human effort that goes into creation of the police force. There's a lot of capital. There are a lot of automobiles, vehicles that the police uses in order to solve the crimes, right? There's a lot of administrative work. There's a lot of paperwork. So when there's a huge list of unsolved crimes, then that means that they are not able to complete their task because the resources are limited. So again, the scarcity of resources means economic problem. Moving on to the next question, guys. A government taxes the production of cars. What is likely to decrease? Okay, the cost of supplying cars. Well, when there's a tax, the cost cannot decrease. The cost will increase as the production of cars is being taxed. The price of cars cannot decrease, because if the government will tax the production of cars, that means the suppliers will not be able to produce as many cars as they could before. So the supply will reduce, and you know what happens when the supply reduces? Let me just quickly demonstrate. This is the supply curve, this is the demand curve. As the supply goes from S1 to S2, the price goes up from P1 to P2. I hope you understand this concept well. So this is wrong. The revenue for the government will not decrease, of course, because tax is a revenue generation stream of revenue for the government. So the government's revenue is likely to increase if they're taxing the production of cars. The supply of cars at every price, yes, the supply is reducing at each and every price. So at each and every single price, the supply curve shifts. The supply reduces, hence the supply curve shifts towards left. So D is the correct answer, guys. Now, moving on to the next question: which pair of economic institutions is most likely found in a market economy? Now, you guys know what's a market economy, right? There are three different types of economic systems: free market economy, mixed market economy, and planned economy. When we talk about market economy here, we mean free market economy. So both these terms are synonymous. Like, you can use free market for the market or market for the free market economic system. So we're talking about free market economic system. All right. Which pair of economic institutions is most likely found in free market economic system? Free accidents. Oh, what's that? Free accident emergency hospitals and charities. No, it's charities, emergency hospitals and charities. Free accidents. That sounds awkward here, because free accident. Let's look at other options. Partnerships and public corporations. Well, public corporations are government entities, so they cannot be a part of the market economy, so this is going to be wrong. B is wrong. Stock exchange and monopolies. Trade unions and local government schools. Now, government schools again is a government-owned business, because it's a planned economy. Usually has entities are owned by the government, and in a mixed market economy, you have both the aspect of the planned economy, that's the public sector, and you have an aspect of the free market economy, that's the private sector. So you can have both these privately owned and state-owned businesses at the same time. So this can either be a mixed market economy or it can be a public planned economy. So D is wrong. Looking at option C, stock exchange and monopolies. Well, monopolies can be just like normal businesses, any other normal businesses that operate in the market economy, and a stock exchange can also be privately owned. So the correct option for the fifth one would be C. Free accident emergency. It's a free accident is kind of weird. It does not fit in here, but when we talk about emergency hospital, they can be either in the free market economy or in the public planned or state-owned businesses as well. Like, there can be government hospitals, so they can fall into either of these categories. Charities can also fall into either of these categories, but free accident is kind of weird, so we cannot opt for option A. A stock exchange can be owned by the private individuals. Monopolies can be run by the private individuals. So C is the correct answer, because in free market economic system, all the resources are either owned or controlled, are owned and controlled. You can say all the resources are owned and controlled by the private individuals, who are free to choose what to produce, how to produce, for whom to produce. So the correct answer would be C. Moving on to the next question, guys. Question number 6. Developers want to increase the size of major retail shopping area in a city. It is thought that the proposal would create hundreds of jobs, be profitable for the shops, but cause major traffic congestion. Okay, so there's a new retail shopping area that's being constructed in a city. It is thought the proposal would create hundreds of jobs. 100 jobs would be created, be profitable for the shops, but cause major traffic congestion. Now let's see what the question is. What economic concepts are directly involved in this statement? External cost and private benefit. Is there any external cost? So when we talk about traffic congestion, that's external cost, right? And when we talk about private benefit, that means retail shopping centers, the benefits that will incur to the retail shopping centers themselves, the private benefits. So yeah, the option A is the correct option. The other options must be wrong, definitely. Social benefit, there's no social benefit here. Yeah, there's social benefit as well. There's creation of jobs. So creation of jobs is a social benefit. The benefit to the third party. And perfect competition. But we don't see an example of perfect competition here, so D is wrong. Private investment and decrease in supply. Well, when we talk about private investment, yes, there is private investment, but is there a decrease in supply? No, that's wrong. Income distribution and inelastic demand. So when you talk about income distribution, no, we don't know anything about income distribution, or we don't know anything about inelastic demand when we read this passage over here. So yes, the A is the only viable option that we have. Let's look at the next question. The diagram shows the price of a product during year 1 and year 2. So we've got 2 years data over here. You can see that the price went up, it shot up, and it peaked at the end of year 1. And from the beginning of the year 2 onwards, the price started to fall and it got back to the exact same level where it was at the beginning of the year 1. Do you understand? Which changes in the demand and supply are consistent with the price behavior in year 2? Which changes in the demand and supply are consistent with the price behavior in year 2? Okay, demand falls by 5%. So you need to understand that. Look, let's say if this is the price point here at the beginning of year 2, and this is the price point at the end of year 2. Alright? So if we make demand and supply curve, let's say if this was demand and this was supply curve, right? That means there should have been a shift, right? So we cannot say that if for the price to get down to this point over here, if this is supposed to be the price point, and if this is the current market price, let's say this is P1 and this is P2, so two things need to happen, or both things need to happen at the same time. Your demand should increase. What do we call it? No, it's supply. The supply should increase for the price levels to go down, or your demand should fall. Your demand should fall for the price level to go down. In either of these cases, you reach at this point P2. Let's see what are the options that we have. Demand, in option A, demand falls by 5% and supply falls by 10%. So what happens when demand falls by 5% and supply falls by 10%? So let's say when the demand falls by 5% and supply falls. So if supply is falling by more than demand, so that means overall the price cannot go down. Let me just erase this because this will confuse you guys. So let's just look at the options. I think that's way more simpler for you guys to understand. So demand falls by 5%, supply falls by 10%. So in net, let's keep a net here. There's a 5% fall in supply. So what happens as a result is that you see this is the supply curve, and this is the demand curve, right? Do not confuse it with this these lines over here, because this is the movement in price. I'm just trying to explain you that if the price point was supposed to be over here at this point, right, then this would be supply and this would be demand. So overall, if the supply decreases, the price will continue to rise. The price will not go down, whereas we want the price to be here at this level. Do you understand, guys? We want the price to be at this level. So as we move, as the supply reduces, we move from S1 to S2, the price level goes up. So this option A is wrong. Demand falls by 10%, supply falls by 5%. So there's a net 5% fall in demand. Or let's say, I wouldn't say net 5% fall in demand, but there's a greater degree of fall in demand, right? But this is also like, okay, it's also one way to kind of understand the concept. So when there's a fall in demand, what happens? The demand curve shifts, and from D1 to D2, and the price goes down. It might shift too much, and the price goes down and reaches to this point here, right? D3 or perhaps even D4. Now this diagram can be confusing for some of you guys, but you need to understand that when demand falls, the price decreases. When there's a shift in the demand curve towards left, the price decreases. If you understand that much, I think it's going to be simple for you guys. I would agree that this, I mean, if some of you think that this question is a little bit difficult to solve, then I would agree with you guys. But until and unless you have not gone through the basic concept of the shift in demand and supply curve. So if you've understood that concept well enough in the classroom, then you wouldn't face any problems solving this question. So B can be the correct answer. Let's look at the other options as well. Here what's happening, the supply is decreasing. When supply decreases, let's say this is demand, the price levels goes up. When the supply curve shifts towards left, the market price goes up. The MP goes up as the supply curve shifts from S1 to S2. You understand, guys? So this is going to be wrong. And here the demand rises. When the demand rises, the price goes up as well. So let's say, okay, let me explain you using this demand and supply curve. So when we move from D1 to D2, you see the market price is going up. So that cannot be the correct option. We want the market price to go down, and the only case in which the market price is going down is the second case here. That is option B. I hope you guys understood it well enough. Well, the question is not difficult if you understand the basic concept of what causes shifts in the demand and supply curves. And that, I think, will need a dedicated class. We have got a limited time here, so we will just solve the answer and move ahead. For those of you who understood it, very good. For those of you who didn't understand, join the class and get a detailed explanation on the concept of shifts and movements in demand and supply curves, and what causes the shifts and movements in the demand and supply curves. Alright, moving on to the next question. A trade union agrees on a closed shop. A trade union agrees on a closed shop policy with employers in the industry. Now, you guys, this is very theoretical. For those of you who don't know what's a closed shop, let me explain to you guys. Closed shop is a term that is used when you have a policy, when the company has a policy, or let's say trade union has a policy, that all of the workers in the company will be the members of the same trade union. You understand? And they will not be. The company will not allow them to be members of trade union or any other trade union, or to let them be, you can say, independent of trade union. All right. So let us look at the options that we have over here. How does this operate? All workers will be members of the trade union. Yep. Employment will be open only to skilled workers. It's got nothing to do with trade union. The employers cannot make workers redundant. This will never be the case, because workers can be made redundant even if trade unions have put utmost pressure on the employers. There are instances when employees are made redundant. Redundancy means they can lose jobs because of changes at the workplace. Workers cannot move between employers. This is not true. So A is the only viable option over here. So we'll choose A and then move on to the next question. When will a central bank act as a lender of last resort to a commercial bank? So a central bank has got some functions, and to be a lender of the last resort to the commercial bank is one of its functions. So if you have read, again, this is a theoretical question, so you don't need a lot of explanation for this. You just need to read the book very thoroughly in order to solve this question. When a commercial bank faces liquidity, so lender of the last resort means that when a business is completely broke and it does not have means to service its debts. Let's say I have a business, I've taken a loan, and I do not have enough money to pay back my loan, and what follows is that I will have to liquidate my business. That means I will have to sell off my assets and pay back my debts, and that would be it. That would be bankruptcy. My business would go bust, and I wouldn't be able to operate any more in the future, and of course there will be a loss of jobs, and the economy would get hurt. So in that case, central bank, which is of course controlled by the state, will lend to a commercial bank, or in the other, in some instances to other institutions as well, not necessarily banks. So when a commercial bank faces a liquidity crisis, will the central bank lend them as a lender of last resort? Yes, this might be the case. When a commercial bank fails to make a profit, no. I mean, no state organization would actually pay to an organization, any organization, whether it's owned by private individuals or the state, to make them any form of payment, or only just because it's making a loss. No. When a commercial bank needs to raise share capital, no. When a commercial bank reduces its lending rates, no. So all of these options are incorrect except for option A, and the explanation is very simple. You need to know the theory and the concepts of the central bank. What is the purpose of the existence of the central bank? What are the functions of the central bank? If you learn these functions, and if you have a detailed understanding of what these functions are, then you will be easily able to understand that lender of the last resort means that the central banks comes to the rescue of any organizations that are facing liquidity crisis, or that are facing threat to their survival because of the issues which can lead to bankruptcy. So we call that liquidity crisis. So A is the correct option. Moving on, next question, question number 10. In the diagram, D1, D1 and S1, S1. In the diagram, D1, D1 and S1, S1 represent the demand for and the supply of labor. W indicates the legal minimum wage. Okay, this is an interesting question. An influx of immigrant labor cost supply from S2 to S2. Alright, so you understand that if this is the legal minimum wage, and if this is the market wage rate, here supply is great, and demand is... the demand does not meet supply, so this is disequilibrium, right? This is the equilibrium where demand and supply curves meet. This is disequilibrium, and in the labor market, this disequilibrium will cause excess supply, which can be referred to as unemployment, because excess supply of workers means unemployment. You have to understand this is labor market. This is not the normal market of goods and services. This is labor market, right? So what happens is because of the immigrants, the supply increases, and we move from S1, S1 to S2, S2. There's a shift in the supply curve. So there's a new market price here. There will be even more unemployment if we stick to the minimum wage rate, because this is the minimum wage rate, and the difference between demand and supply is great now. Now it's D1, D1 and S2, S2. So there's an even bigger, even larger unemployment. But what's happening, this is the new market price. Let's look at the question. How many people will be employed if the minimum wage legislation is then abolished? What happens is that the government abolishes the minimum wage legislation. So the minimum wage legislation is abolished. There's no longer minimum wage law. So this is the new market wage, because this is the new supply and this is the new demand. The new supply and the new demand. You understand, guys? So this is the new, and this is the new market price. So here is your new market price. That is, here is your new market wage rate, MWR. So what happens at market wage rate is that it tells you what the wage rate is and what the number of labor employment is. So there is 7 million people employed. Now the question is, how many people will be employed if the minimum wage legislation is abolished? So the answer is 7 million, because the new market wage rate actually shows us that there will be a certain number of wage. Let's call it W2, and let's call it here 7 million. So this is where the intersection is, and where the intersection is, we will be able to determine the new wage rate, the MWR, and let's call it W2, no problem. We could call it anything. And the new labor employment would be 7 million. So the answer is 7 million. Alright guys, moving on to the next question. The table shows how 3 people spend their income. Food, clothing, housing, entertainment, leisure, and luxury activities. Person X, person Y, person Z. So there are 3 people here, and they have got different spending patterns. We're talking about the expenditure of their income. So person X spends 35% of his income on the basic food, clothing, and housing, and the 25% of the income goes to entertainment, and 40% of the income goes to luxurious goods. And person Y spends even more on the basics, and a little bit less in entertainment, and a little bit less in luxurious consumption. Person Z spends very little on basics, and most of his income goes to, or her income goes to, entertainment and luxury goods and services. So for these 3 people, what is most like the order of income from the lowest income to the highest income? So who amongst these 3 people is supposedly the richest and who is the poorest? So how would you, or let's say who has the highest income and who has got the lowest income? What will be the order in a descending, I think, from lowest to highest? Yes, lowest to highest means ascending order. So the person who has got the lowest income would be the person who spends most of his income, or the greatest proportion of his or her income, on the basic foodstuffs. That's 50%. So person Y has got, so there are 2 correct options. This can be correct and this can be correct. These 2 are wrong. Now I'm not going to highlight them, because of course either of these 2 options can also be wrong, because we have only one correct answer. Both the B and C options are starting with Y. So yeah, here we have got correct start. Now let's look at the second phase of the answer. So person Y is spending 50% of his income, and the other 2 people are spending less of their, or even less proportion of their income on the basic food stuff. So the individual that spends the highest proportion of their income, or his or her income, on the basic food stuffs and the housing, so the basic needs, would likely be the person on the lowest income. And so after Y, who's the other person that spends most of his or her income on the basics, the basic needs. It's 35% and it's person X, right? Because person Z is supposed to be rich. Person Z spends 40%, that is highest amongst all three, on entertainment. Only a rich person would spend most of its income on entertainment and luxury goods, right? So it would be, the order would be Y, X, and Z. So B would be the correct answer. C is going to be the wrong answer. The answer would be B for 11. For question number 11. Now let's move on to the next question. How does a firm guarantee that it makes the maximum profit? How does a firm guarantee that it makes the maximum profit? By maximizing the difference between total revenue and total cost? Of course. Of course. What's the definition of profit? Total revenue minus total cost is equals to profit. This is the formula to calculate profit. Do you understand, guys? This is the formula to calculate profit. So A is going to be the correct answer for question number 12. Look at the other options. The maximum number of goods that it sells. By maximizing, well, you can sell more goods and you can make a loss. So wrong. By minimizing the number of goods that it keeps in stock, you can keep lesser stock and still you cannot have enough sales or maximize profits. Wrong. By minimizing the difference between average revenue and average cost, well, average revenue and average cost will mean that you make very high profit per unit that you sell, but it does not mean that your total profit will increase. You could be making a high profit margin on each and every single unit that you sell, but you might not be making enough sales to maximize your profit. So the maximum profit only be achieved when your total revenue exceeds, or let's say exceeds by a maximum possible number from your total costs, right? So when the difference between total revenue and total cost is greatest, that's when you maximize your profit. So option D is also wrong. So the correct answer is only option A over here. Two firms agree to integrate their activities. Alright, what do you mean by integration? That means they're probably going to combine or merge their activities. What must result? A change in the ownership structure, a lowering of the average cost of production? Look, a move from national to international markets does not make sense over here. We're not talking about international businesses here. It might be just national companies or regional companies, or local companies, right? Not even national. A reduction in the level of market risk. I don't think market risk has got anything to do with the integration of activities. A lowering of average cost of production. Look, average cost of production might decrease or might not decrease. It depends. It is likely to increase. Now, this is a tricky part here. This is not necessarily wrong that the average cost will lower as two firms agree to integrate these activities, because they might benefit from economies of scale. They might benefit from economies of scale, but they might not benefit from economies of scale. Who knows? It depends on how these two businesses come together and how they perform once they come together, right? So, only thing that's certain is that their ownership structure will change, of course. When two firms combine their activities and when the owners form some kind of a partnership, they will come to an agreement and their ownership structure will change. Like, let's say there are two businesses, a business A and business B. So, person A, let's say Mr. Joe, owns 100% of business A. Alright? Joe owns 100% of business A. Alright, and you've got Peter, who owns 100% of business B. Now they combine business A and business B to start a business together, which is business C, and Mr. Joe owns 50% of this new business, and Mr. Peter, just a moment, guys. Mr. Peter owns 50%. So they have a 50-50 partnership in business C. This is their new business, which combines both the business A and business B's activities. So the ownership structure will change. The correct option is option A. Let's look at the next question. The table shows the units of factors of production that firm needs to employ to two different levels of. The table shows the units of factors of production that a firm needs to employ for two different levels of output. what is the firm experiencing? So let's see what happens here. There's an increase in land 1.5 times. When we move from 6 to 9, that's 1.5 times increase. Not percentage, but rather x. 1.9x increase. Alright. Or let's say 150% increase as the land increases from 6 to 9. The input of land increases from 6 to 9. Again here we move from 8 to 9, that's 1.5x increase. Or let's say 50% increase. 50% increase, okay? 1.5x means 50%. 4 to 6, again 50% increase. That's 1.5x increase. You can write 50% increase as well, guys. I'm telling you again, 50% increase as well. 50% rise, 50% rise, and 50% rise. But here in output, because all these are your inputs, but your output increases by 100%. This is your output increasing by 100%. So inputs increase by 50% and output increases by 100%. Is it clear, everyone? Because we move from 100 to 200, that is 2x. That is 2 times increase. That means 100%. When anything increases by 2 times, we call it a 100% increase. So output is increasing by twice as much as inputs. So as we increase, as the firm increases or grows in size, its output is increasing twice as fast as its inputs rise. That means they're having an increasing returns to scale. So it's not constant returns to scale. Constant returns to scale means that the output will also increase by 1.5x or by 50%. So it's wrong. So economies of scale, yes. Increasing returns to scale means economies of scale. That means their average costs are reducing as they expand in size. So yeah. Now, whether it is external economies of scale, no, there's no such reason that tells us that this is specifically external economies of scale. And if you guys don't know what's the difference between external and internal economies of scale, you guys need to refer to the textbook. Whether it is external, well, it's not a diseconomies of scale. If it was a diseconomies of scale, we would have experienced that the increase in the output would have been slower and more gradual or more lower. Okay, again, it's more gradual than an increase in the inputs. So if inputs would have increased by 50%, the output would have increased by less than 50%. So that would have been as a result of diseconomies of scale. But here we don't see that, so it's not diseconomies of scale. So the correct answer here is B. I hope you guys got the answer. Moving on to the next question, question number 15. Okay, this looks like a long question, but let's see. By 2014, government subsidies for the Chinese steel industry led to 200 million tons of excess output. So government is supporting the businesses in the form of subsidies, and the output of the industry was exceeded by 200 million. The diagram shows the market for Chinese steel. So the supply is increasing, of course. When the output increases, what happens? The supply increases. What would represent the position after the subsidy but before the market adjusted? Okay, before the market is adjusted, that means the government has already provided the subsidy, but the market has not adjusted. The market has not reacted to that increase in the level of subsidies. What would happen? Well, look, this usually is a disequilibrium, right? So here is the market price, and this is the disequilibrium. What will happen as a result of subsidies? The supply would increase. We don't see the supply increasing at this point, right? Do we see supply increasing at this point? No. This is the supply curve and this is the demand curve. So A is wrong. Here demand is increasing. Demand will never increase as a result of subsidies, because subsidies support to the businesses, so supply should be affected, not demand. So this is B is wrong. Let's look at question number D. Again here the demand, the supply is increasing. Yes, the supply is increasing over here. So in both C and D the supply is increasing from S1 to S2. So shall we go with option D or shall we go with option C? Now that's where the dilemma lies, and that's where it makes the question more interesting, or you can say confusing. The government subsidies for the Chinese steel industry led to 200 million tons of excess output. The diagram shows the market for steel. So there's excess output, that means the supply has exceeded 200 million tons. This is an interesting point here. So here they have tricked you with this question. 200 million tons of excess. So look, here both the option C and D could have been correct. When we see that option D is the correct option, then what happens here is that there is excess supply, because this used to be the market equilibrium. This will be the new market equilibrium. In the meantime, there is an excess supply of 100 minus 400, that is 300 million tons of output. Right, but what's happening here? Here the same thing is happening. We're moving from S1 to S2. The supply is increasing. The supply curve shifts. Right, this used to be the market price. This is the new market price now. Right, and this is the gap between the supply and the demand. Right, so this is the excess supply over here. What do you call it? Excess supply. Right, and what happens as a result of this excess supply is the market is going to adjust itself. But anyhow, there's a 200 million tons of excess supply. That's the point that you should be focused on, and that's what differentiates the option C from option D. I mean, if you look at the actual figures that have been given there on the x-axis. So the correct answer would be option C. Alright guys, moving on to the next question. A government wishes to stimulate economic recovery. Which action would assist this? Look, a stimulation of the economy means that you're trying to boost the economy. You're trying to increase the economic activity or the spending within the economy. So the government, of course, opt for expansionary policy. For those of you who understand the economic policies, it will be an easy question. For those of you who haven't studied the economic policies, this is going to be a difficult question. So economic policies would mean that the government will actually increase the spending. Okay, so what happens when the government decreases government's investment? Will that stimulate economic recovery? No, because government is decreasing this investment. So the government needs to increase investment to increase the spending. Decreasing income tax, yes, because when the income tax will decrease, people will have more money left with them, so they will spend the money, and that will stimulate the economy. As the spending increases, the economic activity increases as well, so it stimulates the economy. Increasing indirect taxation, no. Increasing taxes will limit people's spending potential. Okay, increasing interest rate would do the same thing. The expenditure would go down as people will not borrow to spend because of high interest rates. People would rather save, and this would further lead to reduction in the public expenditure, or not public expenditure, but consumer expenditure, or let's say other business expenditures, consumer expenditure, commercial expenditure, because businesses as well as individuals are not going to borrow money from the banks because of high interest rates. So D is not the correct option. The only correct option here is B. If interest rates would have decreased, then of course people would have borrowed more, and businesses would have borrowed more to finance their expansion, and consumers would have borrowed more to consume more, of course. So that would have increased the spending. But when the interest rate goes up, it's the other way around. So the correct option is B, decrease in income tax. As the tax decreases, people have more money left over, and they will spend that money, and that will stimulate the economy. Or that will lead to economic recovery. Okay, a government fixes the rate of income tax at 0.2 per dollar earned. Okay, what describes this type of taxation? Okay, to $0.2 per dollar earned, that means no matter how much you earn, you're paying 20%. 0.2 per dollar means 20%, and it's same no matter how much your income is. So that is proportional. When your tax percentage is 20% of all income, because 0.2 divided by $1 is equals to 20%. It does not say that the tax rate increases. When the tax rate increases, your income increases, that's progressive, and when the tax rate decreases as your income increases, that's regressive. And indirect tax is not income tax. Indirect tax is actually tax on other consumption of goods and services, which is called VAT or GST. So that is also wrong. The correct answer is C here. Okay, looking at the next question. A government introduces a law to reduce the restrictive practices of trade unions. What would be the most likely purpose of this law? So what happens when the trade union practices are reduced, it actually supports the suppliers to be able to function better and produce more goods and services because there are less disruptions in supply. So to change from a mixed to a planned economy, to ensure the fair distribution of earnings, to increase the competition in the labor markets. Yes, their competition will increase the labor markets because people will not get unfair advantages from just being part of the trade union. The main purpose of the trade union is to protect the interests of the workers, but sometimes some people will get advantage while the others will be left out. So C is going to be the correct answer for question number 18. To reduce the government expenditure to job training, well, this got nothing to do with the question. So yeah, the correct answer is C. The table shows a government's receipts from taxation. What is the total amount of revenue raised by indirect taxes? Now you guys know what's indirect taxes, right? The taxes which are levied on the consumption of goods and services. And direct taxes are taxes on the company profit tax or income tax. So this will not be the part of the calculation because this the company profit tax is your direct tax. Income tax is your direct tax. This will not be the part of the calculation. Right? Air passenger duty is indirect. Import duty is indirect. Inheritance tax might also not be the part of the calculation. So the correct answer is 385 million. That is option number C. So inheritance tax is also not the correct, because it's not the tax on the consumption of goods and services. It's not the tax collected when people spend to purchase goods and services. The correct answer is 300 million plus 75 plus 10, which is equal to 385 million. The correct option is option C. Moving on to the next question, what would best indicate the start of an economic boom? What would best indicate the start of an economic boom? A negative growth of the gross domestic product. What would best indicate the start of an economic boom? A negative growth of GDP. Look, when there's a boom, right, you have to understand that there are economic cycles like this. There's growth, boom, recession, slump, and then there's growth, boom, recession, slump. So this is growth, and this is boom. This point here is boom, and this point here, this phase is growth when the economy is growing. Let's say this is your GDP. All right, this is boom. This is recession as the economy is falling, and this point here is slump, which is followed by another period of growth. So negative growth of GDP, no, of course GDP will increase, the growth will increase as the economy is going to boom. Rising interest rates means so your interest rates will rise as part of the government policy. And the government might raise the interest rates, might raise the interest rates in order to restrict or in order to limit the spending because of high inflation rates, or they might have their own reason. Okay, they might have their own reason to have a policy of rising interest rates. Their interest rates are set by the central government. We cannot directly relate this to this example or here. At the period of boom, they might just raise the interest rates in order to avoid a recession. They might do so in order to avoid a boom and then a recession that would follow. But we can't look for better options as well. Rising levels of employment. Yes, they're saying it's the start of an economic boom. That means you're still in a growth phase and you're in a boom phase. You're about to reach the peak. So yes, your employment levels are rising and unemployment level will fall to record low. A steadily falling price levels. No, price levels will keep on rising because as the spending increases, the GDP grows. As the GDP grows, the inflation levels will also go up. Do you understand? So the correct answer here is the rising levels of employment. That means your unemployment will be at record low because when the economy is booming and when the people are spending more, and since labor is a drive demand, more employees will be required for recruitment. More employees will be provided jobs, as you know, more labor will be demanded to produce all the goods and services that are being demanded highly during the phase of economic boom. Right. So the correct option is option C for question number 20. Moving on to the next question. A country has a very high gross domestic product and a small population but has the lowest standard of living. very high GDP, that means you can say that its annual production is high, spending is high, the population is small, but low standard of living means that the government has not worked a lot in order to provide a better lifestyle to the people. What may be the cause of this low standard of living? There's high inequality of distribution of income and high provision of merit goods. There's high inequality of income distribution and limited provision of merit goods. Look, if there's high inequality and high provision of merit goods can only be provided to those economies which have got a better standard of living, because at least those who deserve the merit goods will be able to benefit from that, and merit goods have got other external benefits as well. So A is not the correct option for question number 21. There's high inequality of income distribution and limited provision of merit goods. That means merit goods are not being actually supported by the government, and inequality of income is high. So only there are very few people that are benefiting actually, and there's still a huge proportion of your population. There's a huge amount of people that are actually deprived of a lot of good things, because their income levels are very low because of high inequality of income. So B might just be the correct answer. Let us look at the other options. There's equality of income as well. There's equality of income, then the standard of living should be high. And C cannot be the correct option. There's equality of income distribution again, so D can also not be the correct option. So the only correct option here would be the B, because inequality of income means injustice and low standards of living for masses, and a limited provision of merit goods means again people that deserve to benefit from certain merit goods do not get a chance, and merit goods are of course beneficial for the other members of the society as well. So merit goods should be supported by the government, should be provided by the government, in order to elevate the standard of living of the population. So B would actually indicate the circumstances within a country that has low standards of living, even if they have a high GDP, that is gross domestic product. So B is the correct answer. Moving on to the next question, guys. The table gives information about 3 economic indicators in 4 countries: country W, X, Y, and Z, right? Let's look at the options first, because it's a very lengthy table. You cannot remember everything. You can just assume that the inflation levels are rising, 1.4, 3.7, and then it's declining for country. Okay. Interest rates, 3.4, 8.7, 7.36. Unemployment, 10, 12, 14. Well, there's nothing that you can conclude just by looking at the table. Let's look at the options. What may be concluded from this information? Countries with higher inflation have higher interest rates. Does this appear to be correct? Is it true? So inflation is 1.4, interest rate is 3.4. Inflation increases to 3.7, which is the maximum. The interest rates are the maximum, 8.7 amongst all the other countries. Country Y, inflation is 3.6, second highest, and interest rate is also second highest. Country Z, inflation is 2.1, second lowest, and interest rate is also second lowest. This is 6.0. So yes, option A is the correct option. We don't even need to look any further, because this is going to eat up a lot of our time. I mean, if you have got time left over, you can come back and refer to this question, because remember, you have to make the best possible use of your time. Okay, let us look at the question number 23. The weight for a product in the consumer price index has increased. Now you guys need to know how to actually do the calculations for CPI, which is used in calculating your level of inflation. CPI is the basket of goods and services that are actually consumed by the people, which is used then to measure inflation. So, and each of these products has got a certain amount of weightage. Right, so when the weightage increases, of course, this will affect your level of inflation. Any change in in the price of that particular product that has got a high weightage will have a higher impact on the level of inflation. So the product has become more expensive. So the weight of the product in the consumer price index has increased. What is most likely to have caused this adjustment? Why the weight has increased? The product has become more expensive? No, if the product becomes more expensive, the price will increase, not the weightage. The weightage will increase. The importance of the product will increase in the consumer price index is when an average individual is consuming more of that product. The product has been offered for sale in more retail outlets. A lot of products they go on sale, but people do not start consuming more of them. The product has improved in quality and performance. A lot of products improve in quality and performance, but does that increase the weightage? The product has taken a bigger share of consumers' income. Yes. because people are going to spend more of their income on consumption of those products that have increased in weightage. That's what the increase in weightage means. The weightage means that the total proportion of your income that is being spent on the consumption of that good or service. So D is the correct option. Now I cannot explain you the entire CPI concept. For that you will need to join the lectures. So D is the correct answer. Alright, China is classified as developing country. Recently, contributions to its GDP were agriculture 10%, construction 13%, manufacturing 32%, and services 45%. So you can see that the agriculture is like 10 and 13, and manufacturing and services. Service is taken up the most with share. Which contribution of GDP usually decreases first when countries move to higher levels of development? So we can say agriculture will decrease the most because as we move from primary to secondary, the secondary sector becomes more important than the primary sector, because less developed countries or developing countries usually have got a very high proportion of their GDP being generated from the primary sector, which includes agriculture, farming, fishing, mining, etc. So of course agriculture would decrease first when the countries move to higher levels of development. Construction will lead to more development. Manufacturing and services, all of these will actually lead to development. But services would actually be the case when the countries are highly developed. And China, although we call it a developing country, still calls it a developed country, but it is perhaps going to become a developed country very soon, considering its pace of the pace of its rise and the pace of its development, which is surprisingly fast. Alright, let's look at the question number 25. Some people think that the debts and interest payments of the poorest countries in the world should be cancelled. Okay, this is interesting actually. What might be the disadvantage for the poorest countries if this were done? Okay, mainly this is an advantage because they will not have any debts to service, and then they can get riddance of all the interest payments that they have to make on these debts. International banks might be less willing to give loans to poor countries. Yes, if they cancel their debts now, and if these countries fail to make any payments back for the amounts that they have borrowed, they might not be able to secure any loans in future, because the banks that have provided them with loans will avoid giving them loans in future because they know that their debts will go bad and they will not be able to get back their money. So A is the correct option over here. That's a weird A that I've made. I apologize. Here we go. Interest payments to the lenders would fall. No. The standard of living of the people in the poorest countries would fall. No. The standard of living would increase because there will be less payments of interest. Trade between the poorest country and the rest of the world would increase. Not necessarily going to be the case because it's not going to be affected by the interest payments or debt servicing. Okay, which country is likely to have the highest standard of living? Country A, country B, country C, or country D? So yeah, this is like relatively simple question. Look, any country that has got the highest standard of living would have a high expectancy. So life, so A and B cannot be correct. Come on. Infant mortality rate is also high, so it should be low. So death rate is also high, it should be low. So you can say that here life expectancy should be highest, infant mortality rate should be lowest for the country to have a high standard of living, death rate should be lowest, people should be able to live long, and infant mortality means when children die when they're very young or when they're just born, when they're infants, right? So birth rate should be birth rate does not necessarily make a lot of difference to the standard of living. The death rate should be low, infant mortality rate should be low, life expectancy should be high. So yeah, 26, the answer would be D. So D is the answer over here. What might cause the balance on the current account of Mauritius to improve? The balance on the current account of Mauritius. Now you guys know what's a current account, right? Increased purchases of coffee from Kenya. When they purchase coffee from Kenya, the money is flowing out of the country. It's not improving the current account. Increased transport of merchant goods in Greek ships. Not the correct answer. Increased spending by Mauritians on holidays in South Africa. Again, Mauritian money is going out of Mauritius, and they are actually importing services. Here they're importing coffee. Here they're using Greek ships. Increased spending by tourists in Mauritian hotels. That means Mauritians are exporting tourism services, and people are bringing in money into Mauritius. All right. So D is the correct answer over here. Let's look at the next question, guys. A country says that it wishes to increase its trade protection policies. What might that involve? A country says it wishes to increase its trade protection policies. Now, you guys know what the protectionist policies are, right? In which the governments try to restrict foreigners from competing with domestic businesses for domestic markets. So, conservation of resources and taxes on external costs. Conservation of resources is not protectionism. External costs, tax on external costs. Again, external costs is not import, so A cannot be the correct answer. Eliminating waste in the use of resources and grants to multinational companies, this will have an opposite effect. You're supporting the foreign businesses to compete with your local businesses in capturing the local markets. Increase self-sufficiency and increase tariffs. This is the correct answer, because this will have an effect on foreign businesses, as they will now find it more difficult to compete with locally established businesses. So local business will have an advantage here, and this is what happens in protectionism. Price controls and increased regulations on domestic monopoly industries. No. So C is the correct answer, guys, for question number 28. Looking at question number 29. It has been suggested that all countries producing arms should ban the export of weapons and cut production in order to reduce the risk of war. So what will happen when the exports fall? Like, what will happen if this occurred? The balance of payments on the current accounts of countries exporting weapons would immediately improve. No, because they export weapons and they get money in return. So their current account is supported by those exports. So the balance of payments on current accounts would actually deteriorate. It will not improve. So A cannot be the correct answer. The price of existing weapons would fall. How can you say that? Because there's a ban on exports, and the price might or might not fall depending on what it costs to the manufacturers to produce these weapons. Right. There would be a risk of structural employment in industries that are major producers of weapons. Yes, a lot of people that are experts in producing these weapons now will go jobless because their services are not needed anymore, as they cannot export their products. So since labor is a drive demand, again, any demand for these employees or these professionals, these laborers, these workers would be dependent on the demand for the products that they produce. Right, so if they're producing weapons, and if there is not going to be any export of the weapons, then why would they produce these weapons? What would they produce them for? So they will go jobless, and this will cause structural unemployment. There would be no overall effect on the balance of payments countries who produce own weapons. No, of course there will be effect on the balance of payments because their exports are going down. So the correct answer is C, guys. Alright, let's move on to the last question. The US currently trades in oil with the UK. The discovery of new oil and gas deposits in the US will mean that its oil imports decrease and its oil exports increase. So this is the case in US. Alright. The US currently trades in oil with the UK. So the US is going to have a decrease in its oil imports and an increase in its oil exports. So from the initial equilibrium point of X, which letter indicates the new equilibrium point for US exchange rate? Okay, this is a good question. So exchange rates are actually affected by the demand for and the supply of the goods and services that are produced outside of UK and the goods and services that are produced within the UK. So what happens when the imports decrease is that UK is not going to demand the goods and services that are produced abroad, like let's say in UK. So there's less money going out of US. When there's less money going out of US, when there's less cash outflows, and when there's less demand for foreign produced goods, then the supply of the US currency will decrease because they're not demanding any of the foreign products, so they're not supplying their currency. Listen to me very carefully. The supply of US dollar is decreasing, and since they're exporting goods, they're exporting US made goods to foreign markets, right? The demand for the US produced oil is now there in foreign markets, and foreign countries are now buying US oil. They're demanding US oil. So whenever they want to buy US product or US oil in this case, they would need to buy the US dollar as well. They would need to buy the currency before they can buy the products which are manufactured within US. So the demand for the dollar will increase. So what will happen as a result when the supply decreases and the demand increases? This is the point X here. The supply is decreasing. We reach at this point and the demand is increasing. So reach to point B. B is the correct answer here. The demand is increasing and the supply is decreasing. Remember that, guys. Because why is the demand for dollar increasing? Because US is exporting products. Whenever there are foreign countries that are they're buying US made products, they're demanding the US dollar. And US is now not buying any foreign products. So the US is not supplying its currency any longer to buy foreign produced oil. So the supply is decreasing. As a result, we move from point X to point B. I hope this point is clear. So I tried my level best to finish this paper as soon as possible. We had 45 minutes time limit. I didn't even watch the watch. And I just went on as quick as I could. You guys take a note down of it, like how long did it take for me to complete these questions. Now, of course, you are gonna take a little bit more time because you're gonna spend more time thinking and looking at the answers with more care. But remember, you've got 90 seconds. You'd see how much time this entire video has taken to make and judge for yourself whether it can be done or not. And if it cannot be done with you, you need to practice on your own as well. You need to practice a lot of these questions. You need to watch a lot of these videos to be very quick at solving these MCQs within the allotted time limit. And secondly, you guys need to also understand that I have gone through all the options in most of these questions. So some of you will just look at the option when you find the correct answer, just move ahead as quickly as possible. But again, remember that you need to have a balance. You don't even need to be as fast as you could be. You also want to ensure that you also need to double check some of these questions to assure yourself that you have opted for the right answer. Alright guys, so that's it for today, and very soon I will be back with yet another video for you all. Until then, take care of yourselves and have a nice day. Goodbye.